Hello, guys. Welcome to our series Insight with Insiders, where we'll be inviting a lot of traders and investors who will be sharing their investment journey, their philosophy, and how exactly they invest in the markets, and at the very same time, what they think about the markets currently. So, our guest for today's session is Mayank Mehra, who's the co founder and fund manager at Craving Alpha. So, Mayank is a fourth generation investor. His family has been investing for 4 generations now. I'm pretty sure you can calculate the amount of wealth they must have accumulated so far. And at the very same time, what we need to understand is he started investing at the age of 16, and Warren Buffett started at the age of 11, so he's not that very far. Mayank has a very good track record of picking multi-bagger stocks, as you could see it from the returns that the small cases of Craving Alpha has generated. So, in case if you're looking for new investment themes and new investment ideas, make sure that you watch this podcast till the end and get a lot of insights from Mayank, who is the guest for today's session. This is not the only podcast. We'll be coming up with more such podcasts with a lot of traders and investors coming on Upsurge.club. So make sure you subscribe to the channel and hit the bell icon. So we'll start the session with knowing about your investment psychology, your philosophy, and what methodologies you follow at Craving Alpha.
Right. Thank you, Kunal, for this opportunity. Let's start with that. Okay. Again, so with investing, I've been doing it since I was 16, as you mentioned. And I think I got very lucky because my first investment was Balkrishna Tires.
Oh,
And I realized that for any company, and I think like that has structured my methodology going ahead, is how a company needs to have a product market fit, right?
all right.
So we need to see if the company's products are required by the society, and if that company is the best positioned to cater to the society's needs, right? For
All right.
example, with Balkrishna Tires, the company started in 1950, okay?
Right.
Till 1987, for like 32 years, they did not, like, they were doing like multiple things within the tire industry.
Right.
But in 1987, they came up with the off-road tires.
Okay.
And in less than 35 years now, they are India's largest tire company by market cap,
Oh,
and they have like a 10% market share globally.
right.
So we look for companies which have a product which the society needs, because
All right.
in India, the biggest advantage is your population is growing, right?
Right.
If you can
Macros
figure
are
out a
always in
company,
your favor. Yes.
exactly, and if you can figure out a company which has a product that the market can't replace, then they probably will not replace the company, right?
Right. So I think
That's all.
by the time you mentioned, MRF had also become a very good player. Still,
Correct.
still this company was able to do tremendously well because they ventured into something that was, not MRF was catering into, or it was not their focus area. Am I right?
Right. So I'll give you an example. When we picked up Balkrishna, and I mean, I've
Right.
been accumulating personally even till now. And the thing is, at that time, I think BKT was less than 10% of MRF's market cap, right?
Okay.
And today it's bigger than that.
Oh,
So we're investing in the company's idea. Like, we need to know that the management has a vision to figure it out. That might take time. And as investors, I mean, with long term, that's fine. I'll give you another example with Reliance, for example, right?
right.
When Dhirubhai made Reliance, his idea was to make an oil and gas company. Okay.
Right.
But the management, it was so inculcated within the management to create a company like which will keep growing and creating wealth for shareholders, that
Right.
today Reliance is an IT company.
Right.
So you're betting on the
Very,
management,
very truly said. Right.
and you need to see that happen, right? Like, uh, for example, we've never bought ITC, right?
Right.
Because ITC's management, originally ITC was India's, I mean, even today it is India's biggest tobacco manufacturer, right?
Right.
But the company keeps venturing into other businesses which the society can do without ITC in.
Right. Very,
I mean, they're
very
literally just
true.
competing in every other industry.
And
There's
they're
no
number
alpha
two in
there,
everything.
right?
And they're number two in everything. So the company
Yes.
FMCG, they're number two there. Yeah. So
So like we need companies which are doing the best job. I'll give
right.
you a more recent example which we bought. In 2020, we came across Raj Ratan Wires, right?
Right.
Which has made 25 folds since then in
Oh,
2 years. And the idea was, so the management of Raj Ratan figured, they were in the steel business for a while. They figured out a niche in entire bead wires, okay?
right.
And they realized that India was a very competitive landscape. So they went ahead and set shop in Thailand, where they were the only manufacturer. And when COVID happened, all the tire companies had to move to Thailand.
Oh,
So for them, it was like they hit gold.
right. So tire
And
has
like,
been a very good niche that you've picked up, and you have been able to do tremendously well. I think the knack of you understanding the tire business must have been very great by now, and you yourself could start a tire company someday in the future if
I
that
wish,
how well you have understood the business, I guess.
but I think as an investor, I would, if I could someday, maybe just acquire something.
Right. That makes sense. So, again, so since you, as you mentioned, you look out for companies which are growing big and they are the best in the business. By the way, the as you know, we recently compared MRF with JKT. So, mind you, MRF has the largest share price in India, but it is not the largest company in terms of market capitalization. In terms of market capitalization,
Yes.
there are a lot many companies which are bigger than MRF. So that confusion a lot of people have, who are just starting out, that higher the price, higher the market cap. That is not how it works. It really depends on the number of shares the companies are issued. So that is there. So in terms of the future outlook, how do you think the Indian markets are, or are you still handpicking a few companies and are bullish on that, or do you really feel that the entire market would do well? So what's your
Okay, so
take on the future outlook?
I think personally, I'm very bullish on India.
Okay,
I think that's like a professional hazard that we have, like an occupational hazard. As investors, you have to be bullish. And I mean, that's how your brain
right,
starts functioning, right?
right,
You're always optimistic.
right.
And touch wood, till now, it's paid us well to stay
Were you
optimistic.
optimistic in 2020 as well? In March
Yes,
2020?
very.
God.
I was very optimistic. So I'll
Oh,
tell you what
nice.
happened when the market started crashing. Okay. And we had all these companies like Balkrishna and NoSil, Minda
Right,
Industries, all these companies were like crashing down.
right.
And the whole idea was, at one point, me and my dad were talking about this, and we realized that if the markets continue to go any lower, you were
Okay.
getting these companies at like at a throwaway price, right?
Right. Dirt
And
cheap
the issue
valuation.
was people didn't have money. Like I remember, we had called clients, and they had money in their banks, but because they did not have their net banking activated, they couldn't buy
Oh,
in.
oh. And that was
And
a
like,
very short period for which, you could really go and
yes,
tap in the market and get that opportunity.
like a few, I think, just a few days. And that's when
Right.
I realized it's not that the companies are doing bad. It's just that there's this panic where people need to pull out money.
Right.
And we were like, if by chance things turn around, it's gonna be crazy. And like that happened.
Yeah, the index itself gave 2.5x. So I'm assuming the
Yeah.
stocks might have gone 4x, 5x. So in terms of automobile industry, I'm assuming that you have a very good knack of it. How do you
Yeah.
see these big players, this entire, battle of Tata Motors versus Maruti? Given that EV is getting inclined towards Tata Motors and they're gaining a lot of market share there. Do you think Maruti would end up losing its dominance in the industry?
I'll give you a very blunt response to that. Okay. As investors, I honestly don't care which is the best automobile company,
Right.
because I'm not married to any company, right?
Oh, that's amazing.
And the advantage is, by doing what I'm doing. For example, I'll give you, like, for example, my biggest bets right now are BKT, Minda Industries, and
Okay.
SJS, right?
Okay.
So no matter what car you use, you will use the same tires, right?
Right. So you play the
And
ancillary game better. That is what I'm assuming.
yes,
That you pick out
because
ancillary
like the
stocks.
thing is,
Right.
if you're looking for monopolies, right? If you're looking for like monopolies which have a product market fit, the idea is if you have a product market fit, you will not have any other competition, right?
Right.
So I'll give you another example from another industry is steel and cement, right?
Okay.
So we've been very bullish in that space because we're bullish on
Okay.
India and infra has a major
Right.
growth, right? But
Right.
I would not go ahead and buy a Tata Steel.
Okay. Reason being?
What we did last year was we bought RHIM.
Okay.
RHIM Magnesita is a multinational company which is the world's leader in refractories, right?
Okay.
Again, this company originally it started in 1834.
Okay.
So when they founded it in 1834, it took them 54 years to figure out what their fit was. And in
Oh.
1888, they started the refractories business. And
Okay.
since then, their record has been in any country that they've moved in, they have become the dominant player.
Right.
So, I
So
mean, and RHIM has actually given better returns than
right.
any of the steel companies.
Right. So I think putting out the point of having a good product market fit is very important in terms of investing. So whenever you select a company, you also make sure that the product that they are making has a market fit and they can establish and they can that market size should be there in terms of their growth. I think likewise, the entire EV play that has been happening even in the two-wheeler segment. So there's Ola Electric, there is Hero coming up with multiple brands. So we really do not know who would end up as the winner, because right now Hero has the dominance, but at the end of the day, we do not know whether Ola would take away the market share or whether Hero
Right.
would. But if you know that who is supplying rear view mirrors to them, if you know who is supplying tires to them, and if those companies have a monopoly, you automatically win irrespective of either of them wins on the
Exactly.
top. So
I'll
that
give you
that is,
another
I think,
example
yeah,
from that. So in 2016, we picked up Minda Industries,
right.
right? And the interesting thing was back then, this company boasted of being India's largest horns manufacturer.
Oh,
So, and when we started deep diving into the company, we realized that they were India's largest manufacturer of horns, which is
right,
something which every car needs, right?
right.
But the industry was so small that a bigger participant like Bosch would not be interested.
Okay,
And we did face a risk of what if it hit saturation. But the management was so dynamic that they moved from horns to everything else where nobody else would enter. So
okay,
today they're India's most dominant player in horns, switches, alloy wheels, basically everything which is small and no other one will like get in.
right. And do you also have an inclination towards B2B companies more, or you're okay with B2C as well? Because the companies we have discussed so far are more so into, B2B, as in they have greater revenue share coming in from there. So do you have an inclination towards that?
So the thing is when you're researching a company and when you look at customer relationships,
Mm-hmm.
B2B customer relations are more reliable,
Okay,
right? Like B2C customer relations are not very reliable to like research. I mean, so for example, today you can look at a company which has, say, 80% retention rate on B2C, okay?
right,
And tomorrow there might be a disruption which could change that.
right.
I mean, think about it. I'm sure 15, 20 years ago, everyone had a Yahoo account, right?
Yeah, they did. Even I
And
did,
today no one
and
knows, but like,
it was with a very funny name.
yeah. And I
But
think like if you have a good B2B relationship, right? For example, with SJS that we're currently looking at. So SJS has an average relationship time of 10 years with
okay,
their clients. Like, sorry, 15 years with their clients
oh,
and 10 years being like with their largest client.
right,
So these relationships will not go away. So we
right.
can rely on it. It's easier for us to build models with that.
So yeah, and the top line, grows at a steady, decent pace, given that you have, acquired B2B customers who have been for 10, 15 years with a company, because that is something that is very difficult for a company to let go from either of the side. So that
Yeah,
revenue numbers would not get hampered. For B2C companies, that might be a drawback that we all can, witness. So that is one thing that, I really feel that, you are doing a tremendous job there. So on a different line, there's a thing that has been happening in India. So 10, 15 years before, if we look at it, we had a lot of dependence on foreign inflows that were basically impacting the market both in positive way and in a negative way as well. But right now, even if we saw a good withdrawal in 2022, the markets did not get impacted. So what's your take
right.
on that? How has India evolved there?
So there are a few things about that question. Okay. So again, like I think I'm in a good position to answer this question as someone who's been in the broking industry for like 4 generations,
For
literally
generation.
since the beginning of brokerage in India.
Yes.
And the thing is, accessibility is a big deal, right? Like today, as technology becomes more penetrative and accessibility comes in and brokerage keeps getting cheaper, right?
Right.
Everyone will be interested in investing. Yeah, like India has less than 5% penetration.
Right.
Even at this point, we'll have less than 5% people
Right.
in India who are invested. And that's something which can only grow.
Right.
And like the thing is with people like with your firm and all, which is doing a great job with financial literacy, the more people learn about the benefits of investing, they will come into it. And about dependence, I think a major reason why it's come down is the SIP inflows.
Right.
So now people have more confidence on SIPs. Like
Right.
mostly because over the past 5 years, people have seen a market so volatile, and they have realized that it is the easiest way of earning money in the stock markets is to have an SIP. Let the SIP do its job.
Right.
Yeah.
By the way, do you also think that SIPs are impacting the sales of Mercedes Benz by any chance, as the CEO mentioned?
So I think if it is, then I'm very happy that people in India, like, so Indians are very known across the world for a habit of savings,
Right.
right? And I was very scared if the whole spending culture would come into India, then people would move away from saving and move to like spending. But if that's true, then that actually means that people are choosing to not let go of their SIP, but let
Right.
go of their mercenaries, right? Like,
Liability. Right, right, right. So, there's a very different viewpoint which I have been witnessing. So, a country like USA, drives on consumption, whereas a
hmm,
country like Japan, where there is this habit of savings and investing, not investing per se, but savings. So, countries like Japan have not really grown after 1990s or the early 2000s, but US as an economy has grown because they rely more on consumption. So, do you think that the habit of savings of Indians might hamper us in the future, or will sustain through this entire nature of us investing, saving, and investing?
I think we will sustain. So I'll give you an example. Okay, again, like with the whole thing that you mentioned, India is one of the few countries in the world which has a positive real rate of return, even on a bank deposit,
Right.
right? So the thing is, I mean, I would love it if people start spending more money because at the end it'll keep flowing. But even if they do not, the idea is, again, like I think the reason that Japan is so impacted is because they have a very high percentage of the population which is very old, right?
Right.
So even in India, even if you like have the savings habit, Indians on average do not compromise on consumption.
Right.
They
Makes
just
sense.
know वो अपने को पता है कि अपना पाँव चादर के अंदर रखना है.
Right.
So as long as we're not like consuming on leverage, India will grow.
Right. So we are spending, but we are not spending on credit. So that is how we are going, and
Yeah.
that is, I think, the right way to go about it. So kudos to India. So based on the conversation that we have had so far, I know that you are pretty much bullish on automobiles, if not automobiles, the ancillary companies in
Yeah.
automobiles. What all other sectors are you bullish on in the next 4 5 years?
So the other sectors I'm very bullish on is again like infra, as I mentioned. But
Right.
I would not take a position in like a steel company. I would much rather have a position in RHIM. The advantage that we have as small investors is we can buy stock in smaller companies and bet on them growing, right?
Right.
So that's one. The other one is we are very bullish on defense and banks.
Oh, right.
If India as an economy has to grow, banking has to grow.
Right.
Like the economy cannot grow without banks.
Makes sense.
And the other thing with banks is if you think about it, over the past 2 years, banks have an inventory of capital at much lower rates, right?
Right. Right.
And they're deploying it currently at a much higher rate.
Right.
So I
Given
think
all the
banks
rates have
will
increased.
exactly right. And defense, because I mean, think about it. A few years ago, India was buying defense equipments,
Right.
and today we are like exporting defense equipments.
Exporting
Like
some of them.
Ramos is being exported,
Right.
and even Tejas to a point.
Right.
And the best thing is defense companies like Masdok and HAL are currently debt free. Like you're getting these companies which are debt free, which are in like I think around 20 times PE.
Right.
So they're not expensive. If
Right.
you can buy a stock which is fairly valued, if not cheap, fairly valued with great prospects in the future, and if
Right.
the government is supporting that industry to grow, it's
Right.
like it's a sweet spot.
Right. Right. So a PE of 20 with a growth rate of 12-15%, I think, in terms of profitability growth rate, I think that is a very decent number in terms of even PEG ratio. If we see, that comes to about 1.2, 1.4x, which is not that very expensive given the country that we're living in and given the growth trajectory that we're going to witness. So on those lines, I think as a country, we are pretty much in a in a comfortable state, both in terms of economy and as well as in terms of markets. So that's a very valid point put out by you, Mayank. Since you were talking about debt and companies without debt moving at a PE of 20, how much importance, so that debt works as a margin of safety, right? So how much importance do
Hmm.
you give to margin of safety while picking out your stocks?
So I'll tell you something. I mean, margin of safety is extremely important, but
Right.
also comes down to what stage of the company you're betting on, right?
Right.
So, for example, if I'm betting on a company like SJS, for example, right?
Okay.
SJS has been in the business for like since 1989 or something,
Right.
and so they're established.
Right.
But now they're getting into their, I think, what you would call like an inflection point, where
Right.
they can exponentially grow.
Right.
But that has some risk, okay? So I would want and SGS is currently it has like less than 10% debt equity,
Okay.
so it's almost like zero leverage.
Right.
So I'm comfortable buying this. Now, on the contrary, if it was a company which is in growth,
Right.
it would probably have some leverage, right?
Right.
Like either way, it depends on the idea is we look at interest coverage.
Right.
So I don't mind if you have high debt, but can your EBITDA cover the
Uh,
interest payment?
right. Right.
So, and I think there's a very high correlation. It should be like there should be a high correlation in the companies because if you are taking up leverage but your revenue is not growing, so your interest coverage will not grow, right? Like
And it will come down.
basically, if for example, if a company has a 10x interest coverage, that would imply for 3 quarters or something, 3 years, and the leverage has
Right.
grown. We don't
Right.
mind, okay? Because
Right.
that means with the extra leverage, you are actually being able to get extra revenue.
Right.
But if your leverage has gone up and the revenue has not, that's risky.
Right.
I think a recent example is GMM Fowler. So we
Oh
had
yeah.
GMM Fowler in
Right.
2020. So when we bought GMM Fowler, it was a debt-free company.
Right.
Right now, it has like a lot more debt than back then.
Right.
But the good thing is that they also like half of their debt is cash.
Right.
Like they have equal cash of half of their debt,
Okay.
but their revenue has not grown.
Okay.
So I will have to do a lot more calculation on that part to make sure.
Right.
Because like at that point, I'm very confused with what the company trying to do. Like,
Right.
why do you want leverage if you just want to hold on cash?
Right. So what is the point? Because basically the money would not generate returns. If you're taking leverage, you should at least be making 20-25% on that. That then only it will
Exactly.
make sense. Otherwise, it will not.
Yeah.
That is very true. You mentioned about GMMP folder. So I think back then I was reading about GMMP folder and HLE glass coat at the same time together, and I ended up buying HLE Swiss glass coat. So is it the case that you never pick the companies which are second in the race, or how does that work?
We usually never do that.
Okay, fair
Again,
enough.
the thing is, I mean, it depends. Like it depends on the market size and if it like for example, back then actually glass code was trading much cheaper than GM
Right,
Fowler, right?
right,
We probably should have bought actually glass code.
right. Before the
But then
merger, I
GM
think it was
Fowler was
trading at around 10x multiple, so it was that low.
yeah.
Right,
But then GM Fowler was like still was like a much bigger brand. And again, we just had more conviction. It's just
right,
it's easier for us as investors to buy the best company.
right,
If the growth rate is same, then it doesn't matter much.
right. Makes sense. So, given that, when you develop some comfort in a particular company, how high an allocation are you okay to put in that company? Can you go to as high as 15-20%, or you stick to a higher single digit number?
So I'll give you another like a fun figure. In 2017,
Right.
80% of my portfolio was Balakrishna tires.
Oh, that's a very high double digit number. Right,
And that's when we realized like so the thing with us in allocation is if a company is doing good, you have to keep rewarding it, right?
right,
So think about it. This is something I tell all of my clients and like all of my friends also. You should not look at your portfolio as stocks, okay? Look at them as companies and think of yourself as a executive, right?
right,
Like think of yourself as a holding company and every other company in
right.
your portfolio is a subsidiary. Okay. How would you allocate capital?
Okay,
You would probably allocate more capital to the divisions in your company which are making you more money, right?
makes sense.
So why should it be different just because they're listed and just because like you can exit anytime?
Right,
That should not like change it.
right. Does that work in the very same way for small cases as well, or you have a maximum percentage there?
So with small case, like the most recent example we have is with Massdog. So we bought it and it went up 3 times.
Okay,
And so the thing with small case, what we do is we put in the initial allocations
right,
and we let the companies grow. Okay.
right,
And each time that we do a rebalance, all the companies like change their allocations. But if one company is growing exponentially other than the others, I mean, if it's growing exponentially faster than the others, then its allocation will be higher.
right,
And that's just because how it's grown. It's not that we add allocation to it, but we let it like we just let the market forces allocate our capital.
right. So basically, you do not really follow a rebalancing strategy per se, that every quarter you need to rebalance and bring down that allocation to maybe 8%, 10%. it is the rewarding mechanism keeps on continuing, right?
Yes. So like we do rebalance, and like I mean, in the past 2 years, our rebalances have been pretty high because of markets and the volatility.
Right.
The idea is we don't rebalance to reduce an allocation just because it's like gone up or it's too high.
Right.
We just do that because the thing with, again, like the small case, the way it is, that we keep having investors coming in and like at any point in the stock's journey, right?
Right.
So we need
Right.
to make sure that no person invests at a very high weightage. For example, like when we bought Masdog at 300 and then it went up to 890 or something. Okay.
Okay.
For the investors who bought at 300, it was a cheap bet. It was safe, defensive, debt
Right.
free, trading cheaper, all the good things were there.
Right.
But at 900, it's not the case. So, for example, if I had 10 stocks and this was one of them, and it went 3 times, but all the other stocks are still the same, the allocation would be 30%, right? I am okay with my original investor having 30% allocation, but for someone who comes in now, it would be risky.
Riskier, right? Makes complete sense.
And I think like now with small case, we've never had a stock with more than 15% allocation.
Okay. All right. I think that is a good number. I think a very sweet spot
Yeah,
for investors, for retail
that's like yeah.
investors, right?
Another thing we
Uh,
did recently was with tube investments. So one of our small case had tube investments,
right.
which doubled,
Okay.
and which doubled because of CG Power's investment, right? Like,
Oh, all right.
so what we did was we sold half. So like we reduced the weightage in TI investment, in tube investments to half,
Right.
and the remaining half we added CG Power.
Okay.
So effectively, you're still exposed 15% to that, to these two stocks,
Right.
but now we've diversified that over two entities.
Entities, right? That makes sense. So while we were discussing about, at some point we discussed business stories and at some point we discussed numbers. So what is more important to you, numbers or business stories?
So there's something I've been saying this since the beginning of the way the way I started investing. At 16, when I did start investing, I was probably too young to understand numbers, right?
Right.
But I could understand stories. I think
Right.
I was lucky enough to be born with this uh, talent, I would call it.
Right.
So since then till now, I've always looked at stories and I've used numbers to support the story.
Right.
Like I
Okay.
think one of the biggest mistakes we made in investing was with quality dairy, right?
Okay.
So we liked the story. It was coming out. It was being a disruptive specialty milk space, and
Right.
the numbers looked good. The company had had seen quarterly revenue growth
Okay.
till that point. Like they had never seen a negative quarter growth for like I
Okay.
think for like 4 5 years at that point. Okay,
Right. Right.
and the very next quarter or like in the next 3 4 quarters, the company went bust.
Okay.
Right. And then that's when we realized that the story was good, but it has so much leverage. And that's when we realized that how important interest coverage is.
Right.
So that they kept taking leverage in order to like do good business, but they weren't covering their interest costs.
Right. Okay, makes. So basically, we need to, definitely stick to good business stories, but need to back them with good numbers. And the companies which are working on leverage, basically, we need to make sure that the interest coverage ratio is always on our side. At least for 2 quarters, 3 quarters, the company should not face any trouble. That kind of
Yeah.
interest coverage ratio is we are looking at. All right. So that makes complete sense in terms of looking at companies with a lot of leverage. It is a very simple matrix, very simple ratio to follow, where we are simply looking at how much EBIT or EBITDA the company has versus the interest that they need to pay. And if we simply divide them and get to know what exactly the number is, we'll get to know that for how many quarters the company can really sustain without actually generating more revenue, and they can simply pay it from their EBITDA itself, the interest cost. So that is how it works around. So in terms of picking the right stocks, I think you have a very good and sound methodology in working out the numbers, the business stories. But how do you exit or how do you take exit from your bets? How does that work for you, both in the case when it is doing well and at the very same time when it is not performing?
So I think that's probably one of the most that's actually one of the most underrated skills, which is probably the most important as
Right.
investors. So we have a few checks. The first thing is if you have government intervention, you exit. You throw in the towel, you walk out. That's
Okay.
like if any industry has seen any government
Right.
intervention, you just walk out of it. Like no questions asked.
For example,
That's
we
one.
have do we have an example for that?
I have a lot of examples, but like right now, from the top of my head, I can't think of one.
Okay.
I think you remember there was this time in 2017 or something when the government cracked down on these cement cartels.
Right. Right.
And if you think of it
I
from that point on till now, all cement stocks have been underperforming
Right.
up
I
to
was
like I think
tracking I was
2 years
tracking a
ago.
few of the smaller cap cement stocks like Sanghi Industries, Star Cement from the east. They have not been performing well even today. So, in terms of the percentage with respect to the other sectors of the industries have grown. So a very valid point coming in from your
Like
end.
back then we had Heidelberg, we had an exposure in Heidelberg.
Okay.
And as soon as this started happening, and we remember Nilekani coming up on the press conference and talking about the cartel, and that's when we exited it. We were like, this industry is now like it's cursed, it's eclipsed, it's going to stay here, and it's
Now
literally at the same price.
now we
I
also
can't give
heard
you any
of this
examples
coming in.
with small case because like since 2020, the government's been like pushing growth.
Right. That is equivalent to, a very big player coming in and disrupting the sector. So
Yeah. About that, I mean, so we recently were thinking about how if Adani One comes in with their super app for airlines booking and stuff, it might be very negative for Ease My Trip.
right,
But then, oh yeah, getting back to the exit strategy. So that is one.
right.
The other is if we have a company which has exponentially outperformed,
Mm,
but the numbers don't justify it, right?
okay.
So last year, IT sector as a whole was going crazy, like,
Right,
but that was mostly because of the interest rates.
right,
So we exited all our IT positions around last year when it became euphoric. The thing is, I am happy. So the way we look at stocks, we don't look at stocks as the market price. We look at stocks as a function of price and earning, right?
right,
So if the price goes up and the earnings go up,
right,
effectively it's the same for me
right,
because the P hasn't changed.
right,
So that's the second major thing. And again, like we love doing like a partial exit if a stock's like gone up. For example, like Raj Ratan is up 23 times, 22 times since we entered it.
right.
So we've done like we've partially exited it to a point where its dividend flow will be equal to what our investment amount was.
So in terms of IT, do you think now it is the right time, where we can, pick up out IT stocks and start investing in them?
Yeah. So we recently added an allocation on all our small cases.
Okay,
But for IT, what we did is another great thing we've been seeing in India is the ETF market is evolving, right?
right,
India has an ETF called MAFANG, MAFANG, which is by
right.
the Mirae
Yes,
company,
yes, yes.
which invests in the top 10 NASDAQ companies, right?
Right,
If you want to bet on the IT companies as a whole, then that's the best proxy. So that's
right,
what we added. Because
right,
again, like it takes away my hard work to pick which IT company to choose.
right.
And I'm being able to buy like the top 10 IT companies in the US, which is Netflix, Amazon, Google, Microsoft,
All
Meta,
these
right?
companies are there in the index, in the
Yeah, like
ETF, right?
I'm much happier buying that. Again, it's also a contra bet because the entire world hates Nasdaq right now. But yeah,
But I think with the interest rates coming down and settling down, I think it's a matter of time, maybe a year or two, where things starts to pick up again in the US market. So that should not be difficult, is what I assume. But in terms of comfort, Indian markets are at a very comfortable stage where things are looking good, and it is most likely the case that it will grow from here. So that is there.
yeah. You know what's happened is we did this research, okay, and we realized that people like investors 40 years ago made tons of money, right?
Right,
And the idea was 40 years ago, for example, like Buffett, okay, the biggest thing with people who started investing 40 years ago was they did not have the luxury that we have, right?
right.
So you didn't, I mean, this is something which I learned early on because like in 2016, when I bought BKT,
Mhm.
yeah, if you want, you can add into the whole thing.
Right.
So with BKT, what happened was I remember I had to send an email to BKT's investment relations
Okay.
to send me a physical copy of the annual report,
Oh,
right? Because that time, I mean, it was 2010. Okay.
right.
I mean, it's just 12 years ago if you think about it, but technology has changed. And that annual report came to me after like a few weeks.
Oh,
And I remember I had sent that email from a dial up network, right? So it took me 5-10 minutes just to send the email.
oh,
I started my research after 2 weeks. My
oh.
research went on for like 1 month following that. And then I made a decision.
Right.
And today, if you want to buy a company, you can just you no longer are buying companies. Now you're buying like fundamentals or technicals, and
Right.
it's easy. It's free. You just
Right.
go to Screamer and you can now like program it. You just like type in whatever you want. It
Exactly.
gives you a buffet of stocks which fit your parameters.
Exactly.
And then
And you also
you
have
can
so
choose.
many research reports coming in from various fund houses. They're covering the company in and out. They're writing the business model. They're doing everything that is needed. So in
Yeah.
terms of research, the work has gotten a lot easier. But more it gets easier, I think it will be difficult to generate alpha there. That is what also I feel.
See, that's the thing. So what I am betting on is as it gets easier, it will become more difficult for people to make money.
Exactly.
People will start relying on my profession. Like my profession exists because people think that they cannot do it themselves,
Right.
which is true.
Right.
Like I'll give you an example. So in our conversations with clients, right? The average client who's spoken to me from small case has somewhere around 50, 75 companies
Oh,
because they have multiple small cases, right?
right, right, right.
And the idea is that person will never be able to beat the market because diversification at one point will just merge everything together.
Exactly. Even the index has only 30 or 50 companies. So having 70 companies will automatically, you know, uh,
It makes no sense. Like, I mean, the thing is, so again, like going back in time, like 40, 50 years ago, when people, for example, if Buffett researched a company, it took him time. And then when he wanted to buy the stock, he had to call his broker, who would then go into the hall
right,
and then ask for that stock, right? Today, you pick up your phone, go to Zerodha, you buy it, you don't like it, like it doesn't return like 3, 4 days, you sell it off,
right,
it's done. Right? It's so easy. So you can never like I keep telling my clients, you can only make money in investments if you promise to not make a decision for 1 year.
right,
If you tie yourself up, then your research will be so much stronger.
right.
क्योंकि आपको पता है ना कि आप 1 साल तक निकल नहीं सकते हो, आपका exit बंद हो गया है.
Exactly. So
आप like think about it. Like, I mean, I have people like, I mean, so my investment portfolio, when we talk about investment with people, if I asked you that, Kunal, let's start a business, okay? The minimum investment that you and I will think of is at least 10 crores
right,
because you can't start a business for anything lower, right?
right,
Just because you can invest a few hundred rupees in the market and that it does not qualify as a business anymore, right?
right,
And if you do invest, say 10 crores in any business, it will take time to become a business, right?
right,
You will give a 2 to 3 year gestation period just to set shop.
right.
You need to start making money like from tomorrow. Like you
Ex-
bought stock today, it should go up right now.
Exactly. And we need to give that time and consider it more of it like a business in that sense that, given that if you're okay to give 5 years, 7 years to your business, why not give at least 2 years, 3 years to your investments? Because at the end of the day, even those are businesses and they're nothing but, companies which are running something which also needs a good period of time to grow from where they are, where we are investing our money from. So that again makes complete sense that, what perspective we need to develop while we, invest our money in any stock or any company for that matter.
The thing that I like to tell it, like the way I say it for people is if you have more than 35 stocks in a portfolio, then you're just looking for that kick, like you're looking for that bar room discussion in which you walk into your bar with your friends and you say how you pick this stock, which is up 20 times, 30 times, but effectively it made no impact on your
Your
portfolio.
portfolio because you also have stocks which have gone half or maybe down by
Yeah.
30% or 35%. So yes,
Or you simply don't have enough of that stock which has gone 20 times. Like
exactly. Or you have that like you have it for what 2%, 3% of your total portfolio, and that doesn't make sense.
even 2% is a lot. Like I know people who have more than 120 stocks.
Oh my
I'm
God.
like, that's insane. Like,
Right. Even I think the people who have been investing for about 20, 25, 30 years, they just end up accumulating different stocks and they do not really look at their positions or rebalance it or reposition it. So that is something that I've seen with people who have been in the markets for, not very actively, but passively, they have been accumulating different stocks. So उनके portfolio में ये देखा गया कि 100 stocks है कभी कभी 120 stocks है. So at the end वो केवल 10% का ही 9% का ही छोड़ता है और फिर कुछ बनता नहीं है उसमें.
और वो होता क्या है ना कि आप अगर वैसे करके इवन इफ यू हैव 10% CAGR ना, यू आर स्पेंडिंग अ लॉट ऑफ टाइम, योर ट्रांजैक्शन कॉस्ट्स आर हाई, यू आर पेइंग
Exactly.
शॉर्ट टर्म टैक्सेस. Instead, just buy the ETF and let it be. Like
Exactly.
you'll
You can generate
14%
14,
on the.
exactly 14%, 15% you can easily generate there. So that makes complete sense. I am a very big fan of passive investing for people who are very new to the markets and at the very same time for people who do not have much time to, to give it to the markets or maybe hire a fund manager or they do not have that capital size to hire a fund manager. So in those cases, passive investing is like the solution for from my end to them. कि आप ये चीज को
It's
ऐसे ऐसे
easy.
कर लो, this will work out best for you.
And the best thing is you sleep well.
Exactly. You do not really care. So there have been times, when, you even look at a lot of mutual funds, when you compare them with the Nifty index, they have underperformed consistently. So the large cap mutual funds. So that has been there, and the data has started to speak out for itself. In the US, at least, we see about 85-86% of the fund managers not able to beat the index, and the indices there are with larger number of stocks. So that is even worse, that the fund managers are not able to do that. And in India, that thing has started to come eventually, that passive investing is not getting beaten up by active investors. So on those lines, that happens because you end up selecting a lot many stocks. But in your case with Craving Alpha, when you select a decent number of stocks in your portfolio, whether it is your small case or your personal portfolio, or portfolio of your clients, who you're managing directly. So in those cases, given the number of stocks that you keep in your portfolio are decent enough, I think the probability and the scope of you beating the benchmark becomes a lot easier, and the probabilities are in your favor, the odds are in your favor. So yes.
So I think, like, touch wood. So we've been professionally managing money, like advising on money. I have to use the right words because of SEBI. Since 2018, and we've clocked in a decent 30-35% CAGR since then.
Okay.
I mean, we've had times when we've underperformed, but the idea is our biggest luxury is the holding period.
Right.
I think the reason why mutual funds in the world lag the market on a longer term is because they have a herd mentality, right?
Right.
So mutual funds prefer to be wrong together,
Right.
because think of Yes Bank. So we were never invested in Yes Bank because it did not make sense. A bank cannot grow at that pace without having poor credit quality, right?
Right.
I mean, if you looked at Yes Bank's clients, again, the thing with which we do, I will not buy a company that I'm not a customer of. Like, I
Right.
need to test the product
Right.
to see how it works, right?
Right.
And we did our research or our ground research on Yes Bank. We realized that every person who Yes Bank was giving money to were people who were denied capital from HDFC or ICICI or Axis Bank, right?
And that makes a case for us to invest into the HDFCs and ICICIs and the access of the world, because they are denying bad quality loans. So again,
Yeah.
it works out, like, you get to know why you should not invest in a particular stock, and at the very same time, you get to know why you should invest in, some other companies or some other banks that are doing well. So on those lines, that is, I think, very much required in terms of knowing the company, where, you do some scuttlebutting and you actually go on the floor and realize what the company is exactly doing, or how it is managing its credit quality. Even today, you do not support Yes Bank, given how structural changes we have seen, or how the funds are flowing in from institutional investors.
Now the problem with Yes Bank is it has a humongous float, okay?
Right.
And I think the lock-in period will end in March.
Right.
After that, you'll see a lot more supply coming in.
Exactly.
If I had to buy a bank, my current bet on banks, apart from PSUs, like we have Bank of Baroda, Bank of India,
Okay.
and we have, apart from PSUs, we have Federal Bank and CUB.
Right.
You would be surprised to know CUB is the longest running bank in India. It's probably historically one
Oh.
of the first banks in India which exists today.
Right.
The first time it raised capital was in 2020. Till that point, it was organically growing.
Oh.
It has not missed the dividend payout. It has always given dividends.
Oh, nice.
Until 2020, it was the best performing bank in India, like stock wise.
Oh, nice.
And now it's like it's a little beaten down, and there's some bad news coming in from the company. But again, it's a good quality bank.
Right. That makes sense. I think in terms of banking, the quality of bank, the quality of loans matter a lot, and what kind of borrowers they have. So keeping an eye on that becomes very important, and where they're getting their money from is again important. So as you mentioned, SEBI issued their first capital after such a long period of time, and Yes Bank is doing it continuously. So that speaks a few things about the companies that we plan to invest in or research in, at least. So I think that was again a very insightful point coming in from your end, that how you should look at banks, and how you should look at their entire flow of capital, in both in terms of supplying it and at the very same time receiving it. So I think
I think another thing with the biggest advantage of the Indian investor is the Indian DNA has business in it, right? The average Indian knows how to do a business.
Business, exactly. Not if not
Okay.
big, they know how to run a shop.
Yeah, and I'm like, just look in within, like look within and see if you would run this business the way it is being run.
Exactly.
If it is, then buy into it.
Right.
Like, why not?
Right.
But like, I mean, would you ever, if you owned a bank, okay, would you ever want to give poor credit quality people or companies a loan? You would never do that.
Exactly.
You wouldn't give your friend a credit if you knew he will not pay you back.
If you're running a business, definitely yes. Yes.
And like efficiency is like for us, it's quality, it's efficiency, and it's the product.
Right.
At the end, if the people don't like the product, आप कितना भी efficient operation कर लो, अगर product नहीं बिकता है ना, तो वो नहीं बिकता है.
Right. So a good product is definitely, the key of distribution. कि आप distribute कर रहे हो अच्छे से, but at the end of the day, जब आके वो investment world में at least product अच्छा नहीं होगा, जब तक वो चीजें workout नहीं होगी शायद. So I'm pretty sure you guys might have found this session pretty insightful. Mayank had a lot of insights to share in terms of how his outlook for B2B businesses is, or in terms of how the macros of our country look like. So in terms of all those aspects, I'm pretty sure you might have gained a lot of insights. And at the very same time, you also discussed how coverage ratio works and how we can pick out leveraged companies who have a decent coverage ratio. All right, that will always work out in our favor. So that is something that was my key takeaway from this particular session or podcast, as we can say it. And at the very same time, I'm pretty sure you might have gained some insight as well. So do not forget to mention it in the comment section. What was the most insightful part for you in this particular conversation that we had with Mayank Mehra? Thank you.